Hi, everyone, and welcome. I'm Kathy Luker, a CPA and owner of Blue Harbor Consulting. Every week, I go live to help HVAC business owners improve profits and grow their businesses with confidence. Today, we're diving into financial reports. Not just theory, we're looking at real examples of financial statements, so you'll walk away knowing exactly what to look for in your numbers. Financial reports are like the gauges on your truck. Without them, you're driving blind. They spot profit leaks before they drain cash. They guide pricing, hiring, and investments, and they give you clarity on whether your business is actually healthy. The 5 reports HVAC business owners should review regularly are profit and loss statements, balance sheet, statement of cash flow, job costing reports, accounts receivable, and accounts payable aging reports. Now let's walk through each one of these with actual examples. Give me just a moment while I switch slides. Okay, so here's an example of the profit and loss statement for an HVAC company. Notice that revenue is 1.2 million, split between service and installs. Cost of goods sold is 720,000. That leaves a 40% gross margin. That's good. Residential installs should be in the 40 to 50% range. Overhead expenses total 350,000. Sorry, guys, my cat's in here. Net profit is 130,000 or 11%. So what should you look for? Compare gross margin to industry benchmarks. These can vary between markets. Watch if overhead creeps up because you need to capture all costs in your pricing module. Net profit should ideally be at least 10%. If your numbers don't fall in those ranges, you need to look at what's driving your lower margins. Now let's talk about the balance sheet. Cash is 75,000, but accounts receivable is 180,000, meaning a lot of cash is tied up waiting to be collected. Accounts payable and credit card payable total 105,000, and total liabilities are 245,000, with equity at 75,000. So what does this mean? If receivables aren't collected quickly, cash could run tight because your AP and credit card liabilities alone are 30,000 higher than cash balance. Debt versus equity. A healthy debt to equity ratio is often 1.5 to 1. And in this example, it's 3.3 to 1. So the company is definitely over leveraged. Owners should look at ways to reduce their debt and increase their equity. Perhaps they can pay down their debt as long as it doesn't put a strain on their available cash. Can the owner make a capital contribution? Or look at your P&L to see where you can improve your margins, sell underutilized assets, etc. So the balance sheet shows a snapshot. Now let's look at cash flow. This explains where the money actually went. This sample cash flow statement shows operating cash flow of 130,000. This takes your net income of 130, adds back your non-cash depreciation expense of 20,000. The change in AR is negative 50,000, which is good as it's showing your customers are paying their invoices. However, it could also be a sign that your revenue is decreasing, so you want to look at what's driving that. However, the change in AP is positive, 30,000, which shows your accounts payable is increasing. This could be a result of delayed payments to vendors, so you should keep an eye on this and review your AP aging. Investing outflow is 25,000 for a new van. Financing outflow is 10,000 for loan payments. And this results in a net change of cash, 95,000. So the takeaway, even though the P&L showed 130,000 net income, cash only increased by 95,000 once we factored in collections, payments, loans, and vehicle purchases. That's why reviewing cash flow matters. For HVAC, job costing is absolutely critical. So let's look at this job costing report. Job A made 40,000 gross margin, which is good. Job B only made 19,000. Now that's a red flag. Maybe labor or materials went over budget. The actual costs need to be compared to the budget to see where the issue is. And job C was back at 40%. So if you only looked at the totals, you might think everything was fine. But without job costing, you'd miss that certain jobs are dragging your profit down. Next are the aging reports. These show who owes you and who you owe. Here's a sample AR and AP aging report. Accounts receivable is 180,000, but 70,000 of that is over 60 days past due. That's a cash flow problem waiting to happen. Accounts payable, 80,000, with 10,000 over 60 days past due. So what does this mean? You should tighten collections. What payment terms do you give your customers? Send a reminder email to customers a week before invoices are due, and call them if they haven't paid by the due date. Keep vendor payments current to protect supplier relationships. If you consistently pay your vendors late, you might get lower priority service, or they might change their terms to pay in advance, which could definitely cause cash flow issues. Okay, so how often should you look at these reports? P&L, balance sheet, and cash flow, you should review monthly. Job costing, you should review weekly or after each job. AR and AP aging, review weekly. And for specific account balances such as cash, I would recommend you review this at least weekly, and if you're having cash flow issues, review it daily. If you only look at tax time or every quarter, you're too late. You need to be proactive in reviewing your financial reports so you can take action as issues arise. Otherwise, you risk losing thousands of dollars unnecessarily. I once worked with an HVAC owner who was profitable overall, but when we dug into job costing, one crew consistently ran over hours, costing the company $75,000 a year. Once we fixed scheduling and training, profits immediately jumped back up. That's a difference these reports can make. So let's recap. Use reports as management tools, not just tax documents. Focus on gross profit and net profit percentages, cash flow and collections. Review regularly and act on what you see. If you're not sure whether your reports are telling you the full story, let's talk. I'll drop my link in the comments for a free consultation. Thanks for joining me today. See you next week, same time, same place.